Hello everyone, thank you for tuning in. Let's discuss what's going on with the banking industry. It has been on our minds for a long time, and as this year progresses, I'm trying to keep you updated as much as possible because you need to know these things to understand just how different the reality is from what we might hear in the mainstream media on a daily basis. There appears to be quite a bit of confusion, judging by your comments, when it comes to the massive unrealized losses that the majority of US-based banks have been carrying on their books from month to month in hopes that things will improve and they won't need to resort to taking those losses. Well, if and once those losses of that magnitude become realized, we're talking about the 2008 financial crisis being a preparation, just some type of an inconvenience in comparison to what this may entail. Why? Well, because billions in unrealized losses is not the only issue that will impact the safety of the banking sector of our financial institutions. This is a perfect storm, and it will turn into a domino effect. Once there is a bigger crack in the foundation, and we already see multiple cracks, but once there is a bigger crack in the foundation, the entire house of cards will start to collapse. Having said that, let's begin with an excellent illustration that was put together by the FDIC. It will show you the volume of unrealized losses that are currently sitting on the books of US financial institutions compared to historic precedent. This is very, very important because I want you to see where we are versus where we were back in 2008 when one of the worst financial crises began. So take a look. This chart was published by the FDIC, the Federal Deposit Insurance Corporation. It represents unrealized losses on securities held in FDIC-insured banks. Do you see in the far left corner, there is 2008 data, and then on the far right corner, 2024 data. There are two types of securities presented here, available for sale, presented in light blue, and held-to-maturity securities, presented in dark blue. The distinction does not really have any bearing for purposes of our video because from an accounting perspective, from a finance perspective, at any given point in time, a bank can reclassify its held-to-maturity securities into available for sale and then subsequently sell them. So this is just a purely accounting finance type distinction that you really don't need to be worrying about. The FDIC reports that in 2008, unrealized losses on investment securities held by banks were close to $60 billion, whereas now unrealized losses total north of $525 billion. Our banking system is far from being well capitalized to absorb losses of that magnitude. Banks hold mostly US Treasuries and mortgage-backed securities backed by the government. These securities do not face a very high default risk, not typically, traditionally they never have, but they do lose value when interest rates rise. And this is key. I would like to emphasize this. Foreign central banks are now choosing to diversify their reserves by purchasing more gold, as you already know if you're a subscriber of mine, by purchasing more gold and ditching their US dollar denominated holdings. This means that de-dollarization is no longer a myth, it is not a conspiracy theory, it is well underway. When de-dollarization accelerates, which it will inevitably over a period of time, it's not going to be overnight, but over a period of time when the BRICS bloc launches their alternative financial system and depending on how current conflicts in the Middle East and in Ukraine unfold. So when de-dollarization accelerates, US dollars will then return back home. They will return back to the United States, causing high inflation and higher interest rates. That is key. You have to understand this. These US Treasuries that I just mentioned a couple of minutes ago, they will become very risky at best. And since that's what our banks historically default to as a safe investment and hold massive amounts of, it will pose an existential threat to them. Now, why is this a big deal, you may ask? Well, I recall that as of September the 30th, 2023, and I will post a more updated figure on my X or on Telegram, but as of September 30th, 2023, the banking system in aggregate had accumulated over $1.5 trillion in unrealized mark-to-market interest rate related losses on its fixed rate securities, on its loans, and lease investments. These unrecognized losses dramatically increase the probability that the federal government will have to intervene and provide deposit insurance guarantees with the goal to stop systemic bank runs. They already know that our depositors are losing confidence in the banking system and it's an all-time low, and it's probably just a couple of bank collapses away from massive bank runs. Let's just be honest here. In the United States, banks are required to hold capital to prevent their failure in the event of unexpected losses. Capital requirements are based on the value of each individual bank's assets, adjusted for some requirements by the asset's riskiness. So it depends on how risky those assets are. Banks generally favor lower effective capital requirements because capital is a more expensive form of funding than liabilities. They would prefer liabilities over capital, and liabilities, I'm talking about deposits and debt. So they would much rather prefer deposits and debt as a way to fund operations than capital, their own capital, because it is more expensive to do so. Banks, as well as publicly traded companies that you may be investing in, hold their unrealized losses in a very special account. They may choose to realize some of those losses from that account or take those losses, in other words, in some years, but hold on to them in other years. And this is done with the goal to smooth income or loss recognition. It is a standard accounting and finance procedure. It is a standard rule. And someone may argue that this is just some gray area that allows companies to tweak how they present their losses. But in reality, I want you to know that that is not the case, because unrealized losses are actually included in banks' quarterly reports. They're included in their annual reports. So those of us who wish to know if a company or a bank in our situation, if a bank has something sitting in its unrealized losses, you're free to look that up at your convenience at any point in time in their last report that they filed with the Securities and Exchange Commission. So that is public knowledge. It is public data that any publicly traded company is required to include in the reporting, and it is available online. If you are not sure how to look that up, let me know in the comments and I will help you out. You may hear that unrealized losses don't really pose a threat to the bank's solvency. And yes, that could be true if banks were smart enough to hedge against a variety of risks. But what do we think the United States banks did here? Unfortunately, and I'm very sorry to say this, but a recent study showed that 75% of banks do not use swaps, which are effectively hedges. Hedging declined in 2022 when rates rose, and only 6% of industry assets are hedged. The study also describes how current accounting rules reduce banks' incentives to hedge. So, in reality, this means that the purely capitalist worldview to focus on profits, to focus on, your reports looking as good as possible, that worldview ignores common sense and reason when dealing with how fail-proof the banking system has become. Of course, our U.S. consumers are on the cliff here, and they're not sure what to think or what to do, whether they should keep their deposits in the banking system or if they should take them out. But then the question is, well, what do you do with the money, right? When we see official reports published by the FDIC and other institutions, as well as when we hear someone like Treasury Secretary Janet Yellen or Fed Chair Jerome Powell say the banking system is resilient and it is safe, nothing to worry about, We have to take that with a grain of salt, since the data that's given to us is very easily presented in a way that serves a certain agenda. We know that very well by now, right? But these massive unrealized losses is a substantial red flag. As someone who's audited many banks before, I can tell you that this is extremely, extremely important, and this is bad news. We should be concerned. If worse comes to worse, it's not just community banks and regional lenders who will struggle with liquidity, but also bigger banks. Commercial real estate debt that I've covered in great detail previously in many videos is not a can that you could just keep kicking down the road, hoping that nobody will notice. And if you would like to learn more about the banking system and the threats that commercial real estate debt currently represents, there are multiple videos here on my channel that I uploaded recently that will help you out. So feel free to browse and pick one that you would like to learn from. Thank you for watching. I truly appreciate your time. Remember to subscribe on Rumble and YouTube. It's always good to have a backup, so Rumble is a wonderful, wonderful platform. And make sure that you give me a follow on social media platforms linked in the description below for more frequent updates. Thank you for watching this quick video. I hope that it was helpful, and I will see you back here tomorrow. Take care.